Alright, let's try it one more time, and first of all I'll do an overview of the 4 ways, and then I'll do each one of them individually to give you a guide. So what we're looking at is how much of your sales that you have received on account will not be collectible, which means who's not going to pay, and then what do I do with it? Well, first of all, you don't want to pay taxes or show revenue that you're not going to receive, so you have to get it off the books. Now, when you put it on the books, you debited accounts receivable and you credited revenues. So you want to make this reverse that, in essence, okay? Let's say 15 and 15. Now, you can't just take it directly out of revenues. That is an account you don't want to be adding and subtracting to. You always want to just simply be adding and then show an adjustment on that revenue. So for this, you have accounts receivable that you're going to have to zero out, which is a credit, correct? And you want to deduct from revenue only via an account, not into revenue. So a bad sale is actually an expense, so we call it a bad debts expense. And that comes directly off of revenue when everything is said and done. So what I'm going to do is a bad debt expense debit, and then an AR credit, which gets it off the books. This takes it out of revenue when we do the income statement. This takes it out of accounts receivable and off the balance sheet. So we've lessened assets and we've adjusted revenue only via an account rather than directly to it. So that's what we're doing. We need to get it out of accounts receivable and get it out of revenues. The way you do that is by bad debt expense and by crediting the accounts receivable. Now, there are 4 ways of doing it, and there are probably more than that, but I'm not going to get into all of the different modifications that you could do. So, the first way would just be a direct write-off, just very similar to this. Bad debts, accounts receivable, I'm done. The problem with that is, again, if you were to do that, first of all, if somebody pays again, if you decide somebody's not going to pay and then they turn around and pay, then you've got to reverse all of this, right? And you are playing with an expense account that's going to have a lot of ups and downs in it. So you want to try and level that out. Just like you don't want to be messing or adapting that revenue directly. An expense account will be looked at in similar ways by the IRS. So if there's a lot of activity on an expense account, as far as going up and down, that becomes a problem. The other thing is this accounts receivable is always being adjusted up and down. It's much easier sometimes to use what they call the allowance method. And it levels it out somewhat. So what you will end up doing in an allowance is you'll look at the annual, let's look at the annual sales, and we'll say, oh, 3% of those are going to be bad. So at that point, then you would say, okay, my bad debts expense is 3% of sales, so I'm going to debit it. Let's say it's $100. So 3% of that is $3, right? But instead of adjusting accounts receivable because I don't know who's going to be bad. I create an allowance for bad debts. So now when somebody pays again, instead of, let's say we have a bad debt. Let's move that down. That's good. So now instead of hitting that bad debts over and over and over again, when somebody doesn't pay, I'm going to credit the allowance account and lower it. Helps if you spell it right. And I'm going to credit the AR account for $1. Let's say one person owed $1. So I credit the allowance account, I debit the allowance account, and I credit the AR. What this does is it removes, okay? You'll notice it removes. I'm not hitting bad debts, I'm not hitting revenues, and it just makes it cleaner. It takes and creates a system off to the side. Not only that, I don't have to wait for somebody to have a bad debts to have this expense show up. We know it's going to happen, we just don't know when and we don't know who. With the allowance account, this allows you to be more fluid and more flexible. Now if somebody comes back and says, I'm going to pay that, then you would debit the AR again, even though you are having to create another invoice or to do activity on the accounts receivable. It is better than playing with the revenue and the expense accounts. And then I would add that back into the allowance account, just as if that transaction never happened. And then I would show the cash and the AR credit. So there are like three entries you would make with that. Your first one is to establish the account here. When somebody actually, you have to write off their debt. That's one. Here's one. Here's two. And then if they, let's try that one again. Here's one to write it off. This writes it off. This is when you actually have a bad debt. Instead of doing the bad debts debit, you now do an allowance to the account debit. This would be if 3 and 4, these two right here, are only used if they come back and pay that account, and then everything's been reversed. And this happens very seldom, but you still have to know the procedure to do it. Now, when you use an allowance account, there are several ways to set up for that allowance, I guess is the best way. First way is % of sales, and that's % of annual sales. You'll notice it's credit sales here, but it's annual credit sales. When you use this method, this is the one where I said you do not do adjusting to the allowance account if there's already a balance in it. There is % of accounts receivable, and this looks at all of your accounts receivable from prior years. So this one does require an adjustment. These two are fairly common. The one that's used for precision, if you want to call it precision, is the aging of accounts, where you look at each period of accounts that you have, such as not due, due, overdue, 1 to 30, 30 to 60, etc. And each one of those are assigned a percentage of being bad. And you'll create a table, and then you'll have a list of uncollectibles. This one's much more precise. And then you would have the allowance accounts here. So that is the 4 ways: direct, percent of annual sales, percent of accounts receivable, and the aging of accounts. So next we will do individuals.